Hi everyone, I wanted to spend a few minutes with you talking about deadweight loss. Now, what is deadweight loss? Deadweight loss is the decrease in the total surplus resulting from market inefficiencies or distortions. On the right here, I have a supply and demand model where markets are operating efficiently. And we know that right off the bat because markets are operating at their equilibrium point, which is where supply and demand intersect. Now, what causes a market to move away from this equilibrium or become inefficient or distorted? Well, I am wanting to discuss with you price controls and taxation. And all of those are forms of government intervention, and they all result in market inefficiencies. And on the right, I have our supply and demand model, and then I have our price ceiling. And you'll notice that this price ceiling is below the price equilibrium or the equilibrium point. And that is because if this price ceiling was at or above the price equilibrium, it would be ineffective because it would have no impact on the market's decision on its price, because markets are going to operate, if given the opportunity, at this equilibrium point. So if this price ceiling was above this point, markets would never reach it. An example of a price ceiling would be rent controls. Now, rent controls are mandated rent caps or maximum rents by the government to ensure that lower income individuals or families have access to affordable housing. Next, price floors. You'll notice that the price floor is above the equilibrium point and the equilibrium price. And much to the similar reason as price ceiling, the reason for this is because if the price floor was below that equilibrium point, the market would never actually reach that price floor because markets would operate at this equilibrium price. So in order for a price floor to be effective, it must be higher than the equilibrium price. An example of that would be minimum wages. Minimum wages are minimums on how much an employee can be paid by their employer, and those also lead to market inefficiencies. Now, taxation. This is the one that I really wanted to kind of dive into a little bit deeper as we understand its impact on deadweight loss. And so, as we see here, we have our supply and demand model, and then we have these little areas kind of sectioned off. As a quick review, you might recall that areas A, B, and C together give us our consumer surplus. And that is because there are consumers within this area that are willing to pay this price. And so as long as they're able to pay below this price at this point, that is going to be their surplus. Similarly, we have our producer surplus, which is EDF. These three areas together. And that is because there are producers within this area that are willing to sell at any point along this line. However, when they're able to sell at this point, they receive a surplus. Now, you might be starting to intuitively wonder about what these two mean and why they are shaded. We're about to find out. So taxes can be placed on the seller or the buyer. Now, there will still be deadweight loss, and I want to prove it to you. So when we have taxes taxes levied on buyers, we will see a demand shift that is leftward. So we have this demand curve, and it will shift leftward to D2, which brings us to this Q2 point. Now, if taxes are levied on sellers, supply will shift leftward. And again, we are at this Q2 point. So you'll start to see that consumer surplus and that producer surplus that we just talked about starting to get cut into and taken away. Now let's look at this all together. We have our table here, and we have our values for how to find our consumer surplus, our producer surplus, our tax revenue, and our total surplus when there are taxes and when there are not taxes. So again, we have our consumer surplus without taxes. It's going to be A, B, and C. And then our producer surplus without taxes. That's E, D, and F. Now, when we are faced with a tax, this C and E area is taken away from that total surplus. And this gives us our deadweight loss. Now, I want you to think back to when we talked about the price floor and the price ceiling. Can you kind of start to imagine where we would be able to find the deadweight loss when faced with either of these circumstances? Recall that our consumer surplus is above the equilibrium price point and on the left side of the demand curve, and that our producer surplus is below the equilibrium price point and to the left of the supply curve. We're able to figure it out. Here's our deadweight loss when faced with a price floor or a price ceiling. And again, our once consumer surplus and producer surplus, which took up this whole area as our total surplus, has been nearly cut in half due to deadweight loss. Thanks for watching. I hope that you found this to be of your benefit. If you have any questions about deadweight loss, please feel free to message me, and I'll be happy to guide you through any other information that you are struggling with. Thank you.